Good morning, everyone. Jonathan Gerber here with RVW Wealth. Welcome to our webinar on post-election and what we can look forward to in cooperation with Apollo Lupescu of Dimensional Fund Advisors. A quick introduction about Apollo as well as Dimensional Fund Advisors. Apollo is a vice president at the fund, which manages over $800 billion. Dimensional is not a household name, because they work exclusively with advisory firms such as our firm, which share the vision and ideals with Dimensional. I would summarize those vision and ideals that we share with Dimensional as being strategic and tax focused, rather than stock picking, market timing, or thematic. And therefore, we've had a fantastic relationship with Apollo and Dimensional for many, many years, because we truly sing from the same hymn sheet. We and Dimensional are not in the prediction business. What we are doing here at RVW Wealth is looking at the facts on the ground as they present today. And that's always true. And we do that primarily through ETFs, exchange traded funds, which adhere to specific rules. Those rules look at the present rather than the predictions of the future, and not at the historical performance or results. And those facts on the ground, which we focus on and filter through the funds we select, many of them coming from Dimensional Fund Advisors, will select and choose different companies, industries, and sectors based on what's happening in real time. And those facts will change. And we would like to hear from Apollo. So Apollo, I'll bring you on to tell us a little bit about what we're seeing on the ground, what we can anticipate seeing over the next number of months and years under the new administration. And from there, the rest of the order of the day is Apollo will then turn it over to my father to talk about some year-end tax planning and strategy ideas. And with that, with no further ado, Apollo, take it away. Thank you.
Well, Jonathan, first, thank you so much for the invitation to be here, and thanks to everybody for taking the time. And you're absolutely right. I think that what Jonathan just mentioned is probably the most important element in investing. It is not about what product you have, what stock, what mutual fund or ETF. That is not the most important decision. The most important decision is having a financial plan that looks at your circumstances, your needs, your risk capacity, and ultimately, based on that plan, there's an allocation between riskier investments and safer investments. And that is, in my opinion, the most important decision in investing. And to stick with that plan, though, what you have to do is make adjustments along the way, for sure, pay attention to taxes and costs. But also, as an investor, you have to understand what is going on in the world, because if you let events of the moment derail that plan, that's not going to work out very well for you. So what I'm here to do is give a bit of perspective of what is going on in the market right now and how it might tie into things that you hear in the news. Things that you talk to friends about, and that might impact your view on investments. So this is all about educating you about what is going on in the world right now and how are your investments doing? What does it mean for the future of your money? Should you make any changes? So to begin with, let's just look at 2024. We're almost at the end of the year. And it has been a good year in the stock market. In fact, it's been quite a remarkably good year in the stock market. And what's fascinating is I'm going to start with the third quarter, or actually the first half of 2022, because let's just take it by halves. And if you look at the first half of 2024, this particular year, if you look at the Dow Jones Industrial Average, which is the most commonly used metric by the media, but for the first 6 months of the year, that metric was up a little bit below 5%. So let's just say 5%. I'm going to use some rough numbers, not to be overly precise. So that was a good result. The long-term average per year in the market is about 10%. So we got about exactly what we expect, half of that. Now, that's not the only metric, because the Dow Jones is a collection of 30 companies somehow randomly chosen. And in the US market, there are roughly about 3,000 companies. So the Dow Jones doesn't include a lot of the companies that you can buy and sell on different stock exchanges. It doesn't include Google. It doesn't include Amazon. It doesn't include Tesla. So there are a lot of companies not in that metric, and because of that, professionals don't really use the Dow Jones, but rather the S&P 500, which is a broader measure of the largest 500 companies in the U.S. market. And for the first 6 months, that metric was up about 15.3%. So quite significantly more than the Dow Jones. And then you had a third metric that you hear quite often on the news, which is NASDAQ, quite often associated with technology stocks. And we'll come back to this in a second. And NASDAQ for the first 6 months was up a whopping 18.6. So let's just call it 19% for the first 6 months. And when you look at these numbers, what's interesting is that you can ask the first obvious question: well, how did I do? Was I closer to the Dow Jones or closer to NASDAQ? And you folks were somewhere in the middle, and I'll explain the second why. But the second legitimate question is not only, how did the market do, but what exactly is the market, and how come we get all these different numbers? Why do we get these numbers? So to do that, I'm going to use the S&P 500. Because the S&P 500 is the most commonly used metric by professionals, and that's the one that I encourage you to pay attention to on the news rather than the Dow Jones or even NASDAQ, and I'll explain in a second why. And to understand that, you have to look at and see that the S&P 500 is a collection of 500 different companies. And these are stocks that each had a different performance for the first 6 months. So certainly a lot of variety of returns. Some made money, some didn't make money. For example, UPS was down, FedEx was up. So it's not clear which ones are going up and which ones are going down. So then the question is, how do you get from 500 different performances to just one number? And the way that the S&P does it, it takes account not only of the individual performance of a company, but also its size. How big is that company? And the larger the company, the greater the emphasis that the S&P puts on the performance of that stock. And the largest 7 stocks in the U.S. market, which are the usual suspects, it's Microsoft and Apple and Amazon, Google, Tesla, Facebook, and NVIDIA. Over the past 6 months, I mean, they got this nickname of the Magnificent Seven. Actually, even go back to 2023, and the reason they got this nickname, if you set them aside, you take them to the side and you say, well, how do they do, given that the market as a whole is about 15%? What's remarkable is that these 7 stocks went up a whopping 36.9%, almost 37% in performance for the Magnificent Seven. So phenomenal performance on average between these 7 stocks, and they left a hole in the S&P. And if you now look at the remaining stocks, the 500 minus the 7, so the S&P 493, they also went up, but a much more modest 5.1%. And this is very interesting because you take an average of about 5.1 from 493 companies, you add these 7, and somehow the average moves from 5 to 15. And these are giant companies in the S&P. They're not some smaller shops. You got the Starbucks and you got the Nike and you got all these Boeing and so forth. So a really large company, yet these 7 companies were able to lift up the entire market performance between the 7 of them by quite a significant 10%. How do they do that? Well, the reason for that is that when you look at the percentage in the S&P of these 7 companies, what's called the weight, these 7 companies amount to about 32% of the value of all stocks in the S&P, which is kind of interesting, which means that 32% of the performance of the S&P is driven by 7 companies, 7 stocks. And that's why they had such a big impact. But what's also interesting is that the exact 7 companies are also part of NASDAQ, but they're not at 32%, rather 54%. More than half of the value of NASDAQ is in these 7 companies. So very, very concentrated. Think about it. Half the performance of NASDAQ, more than half, driven by 7 companies. And then in the US, as you know, and Jonathan and Senwell and the team have been talking about this, they're not just these large companies, but they're rather a lot of other smaller ones, which have a lot more potential to grow over the long run. And if you include that group of stocks and you look at the metric of the broad US stock market, or called the Russell 3000, that has the S&P plus the smaller ones, the same exact 7 stocks will be part of that metric, but only at 28%. And if you now consider a global opportunity set, which is what I believe RW Wealth does, when you look at that global perspective to investing, the same exact 7 stocks will also be part of that metric as well, but not at 28%, rather at about 18%. So this is where it gets really interesting, because if you look at these numbers and you look at the S&P 500 versus NASDAQ versus the market, I absolutely expect they're going to behave differently. They're going to have different results. And in a period when these magnificent 7 are flying high, well, which one of these metrics is going to look the best? Well, obviously the one that has the biggest concentration in them, and that is the NASDAQ Composite Index. And which one is going to look not as good? And someone had a really nice zinger yesterday. It's underperformance by design. We want to have a less concentration in this. We don't want to rely on these stocks that much, and I'll tell you in a second why. And that would be the global portfolio, what is likely what you have. And in that respect, if you see that your performance doesn't match NASDAQ, it's not that anything went wrong, not at all. It happens that these companies these companies are basically in the same allocation in a smaller proportion, because you have a lot of others in your portfolio. So why would you want to do that? Underperformance by design? Well, if you look at NASDAQ in 2024, they did really well. But also NASDAQ in 2023, it also did very, very well. In 2023, it was up a remarkable 44%, which is a fantastic result. And that's where a lot of people are saying, well, maybe I should put more money into these 7 companies. Now, the warning is that whenever you concentrate, you can either make a lot of money. It's also very possible that you can lose a lot of money. And all you have to do is take one single step back and look at 2022. In 2022, the same NASDAQ was down about 33%, which is a lot. It's a lot. So what happens is over these 2-year periods, either you can make a lot of money, which is what happened in 23, or you can lose a lot of money. Now, what if you had exactly the same stocks, but instead of 49%, you have them only in a smaller proportion, as we talked about it? Well, the first big benefit to you as an investor is that you shrink the range of outcomes. You take away these extreme outcomes that you don't need to accomplish your financial plan. And that's a really big benefit. So you're not going to have these wild swings in your wealth. You're going to have some boundaries. But does it mean that you are leaving money on the table? And the answer is, look at the numbers. If you look at NASDAQ over these 2 years, it is still negative. It's down 2.4%, despite having that big performance in 2023. And if you look at this globally diversified portfolio, that might have disappointed you. For sure, it disappointed you in 23, because you look at NASDAQ, wow, it's up 44%. I'm only up 22%, only 22%. You'd be disappointed. Well, here's the thing. It's underperformance by design, because if you look at these 2 years, not just at 2023, take one single step back, what you see is that the globally diversified portfolio over these 2 years, in fact, delivered results better than NASDAQ. It outperformed NASDAQ despite the fact that in 23 it didn't shine as bright. So to me, it is a really important reminder that if you're an investor, the first thing you want to do is avoid these extreme outcomes. And the second thing they want to do is really make sure that you still get good results. You still have exposure to those companies. And, we looked at negative 44% to negative 33 in NASDAQ, which is about half in Magnificent 7. If you look at the Magnificent 7 by themselves in 2023, they were up a whopping 105%. So if you go from half your money in Magnificent Seven to all in Magnificent Seven, boy, you would have done really well in 23. But in 22, you would have lost almost half the value of your investments. And for folks who are saying, I'll take the 45% down if I'm going to double my money, I'm just going to do one quick bit of arithmetic that like anybody can pretty much follow. If you start with $100 in 2022, and just to make it easy, let's say you lose 50%. By the end of the year, you would only have $50. So if you now start with $50 and you go up and you want to go back exactly to where you were at $100 in 2023, going up by 50% is no longer enough. You have to go up by 100%. You have to double your money. So when you see these great results, it's not that these stocks are flying high. They're not flying high. They're just catching up because of such a steep loss. When you have these steep losses, it takes a lot to crawl your way back up. And that's exactly what we are seeing. So it has been a really good experience for investors who are diversified more broadly than the Magnificent Seven. And at the same time, there are going to be times when you're going to feel disappointed. Now, what's also fascinating is that if you now look at 2023, this year, 2024, and you look at the first half, the Magnificent Seven did really, really well. And then now when you look at the third quarter, which ended at the end of September, what's fascinating is that these Magnificent Seven significantly underperform. They don't always fly high. And in fact, the average of the rest of the S&P outperformed the Magnificent Seven. So it's not consistent that these stocks go up or go down. It's good to have them as part of the portfolio. I'm not suggesting at all don't have them. I would just say be cautious and have them commensurate to their economic value, commensurate to the value in the market. And that to me is a better way to do it than try to hop all over them to kind of say, I need to have all of them in the Magnificent Seven. They might or might not work out. And, it's a great technology. It is part of your portfolio. I'm not sure that all these companies have figured out how to monetize it yet quite well. And that's a legitimate concern. They're spending a lot of money in investments. And I'm not sure that they collect enough in revenue, because it is becoming a bit of an arms race between Google and Microsoft and Apple and Facebook. All of these are providing AI that are all different from each other, and they're all competing with each other. And again, I'm not sure how well they monetize it relative to some other investments, such as Ozempic or Wegovy. We all know in Los Angeles, everybody wants to get their hands on these medications. Well, those are made by a Danish company called Novo Nordisk, and they certainly have a line for years to get on those, and they figured out how to monetize different types of products. So it doesn't have to be all AI. And speaking of global perspective, that's also important to note that investors today, they do have a global, most investors today, they have a global perspective. So it's not just all about it's not just about the U.S. market, but having pretty much around the world, having different investments. And if you have that global perspective, what's fascinating to see is that different countries had different performance for the first few months of the year. And it's really interesting. The only reason I bring it up is because I was fascinated to see that up until just a few weeks ago, the Israeli stock market actually outperformed the U.S. market. Despite that we're doing so well, and despite all the craziness that's going on in the Middle East, the Israeli stock market has been on a tear this year. Up to now, it's about 20% up. So again, it's nice to participate not just in the U.S. market, but really markets around the world. So that's that's what we typically consider the stock portion of your portfolio, which is the part that typically grows the most over the long run. But there's another consideration, which is something that's a little more stable. Stocks are about ownership in companies, and the value of the ownership is based on profits. Profits fluctuate, so does the value of your stocks. And it turns out there's an alternative to this. If you're not comfortable with the uncertainty of the ownership in a business, well, you can lend your money to corporations and the government, including the U.S. government, foreign governments. And when you do that, there is a contract that specifies an interest rate that you get, for how long you get that interest rate, and at the back end, you get your principal returned to you. That is what's called a bond. And the appeal of a bond is that there's a contract that tells exactly how much money will you make on that initial investment. And a lot of folks find that comforting. And if you deal with the US government, for example, they have never missed an interest payment or principal repayment. So it is considered to be quite a safe way to deploy your capital. And a lot of investors like this. So interest rates have been big on the news, because you've heard a lot about the Fed cutting rates and what's going on there, or you've seen mortgage rates going up, what's going on there. So let's talk now interest rates and these bonds, which are really important to a lot of people because they tie into a lot of things that impact our life. So when you think of these interest rates, it turns out that historically there has been a relationship between the length of the contract, which is called maturity. When does the contract end that you get your money back, and the interest rate that you get as an investor? And the big word that I'll throw there that investors use is called yield. In other words, what's the interest rate that you make on your money, or the yield? And if you, let's say, deal with the US government and you give them the money for 30 days, and after 30 days you get your money back plus interest, there's not really a lot of risk associated with that. And you're going to get an interest rate, but it's not very high. You're not going to make that much money. Historically, that's been the case. Now, if you look at giving them the money for a longer time, let's say 1 year, well, my money's locked up for longer, you get to keep it longer. I do expect a bit more in interest. So the interest rate on these 1 year bonds historically has been greater than 30 days. And let's say you can go them and give them the money for 5 years. And if you do that, then obviously I want a little bit more on my money. And even as long as 10 to 20 years, you can lend the money to the government and you would get paid a little bit more. That's been the historical norm. And if you connect all these points, which relate the maturity, the length of the contract with the interest rate that you get, what you obtain is something called the yield curve, which is simply, telling you, hey, how much money in interest would you make based on the length of the contract or the maturity of that bond. And this is what's called the normal yield curve, because that's kind of been the historical norm for bonds. Now, what's interesting is that over the past 2 years, we had to deal with some inflation. And there have been some changes in interest rates over the past 2 years that are really important for you to know, because they do impact you quite a bit. And there are two things that I want to point out, which are unusual but not unprecedented, and they really made a big difference in changing this normal way in which interest rates worked. And the first thing that happened was that interest rates at the very short end, like the very short, I mean like 30 days, they jumped from next to zero to, at some point, 5.5%. You could have made 5.5% by giving the government money for 30 days, which is a lot. And again, I said it's not unprecedented because in the 1980s, it went from 0 to 18%. So that was a lot. This is still a lot. It's just not as crazy. So that's one unusual thing. But the other one that's quite interesting is that if you now lend the money for a year rather than 30 days, you're going to get paid less. If you give the money to the government for 5 years, you're going to get paid even less. And it's kind of the same for 10 to 20 years. So you still have this connection between maturity and the interest that you get, and it's still a yield curve, but now the technical term is called inverted, meaning it's a bit upside down. And this is unusual, but not unprecedented, and it has real implications for all of you. The first implication is that when the Fed cut rates, it turns out that the only rate that they impact is the very short term, roughly in this particular area. That's the only rate that they impact. They don't impact any other rates for 5 years, 1 year, 10 years. They don't do any of that. They just impact the very short-term rate. So when they drop the rates, what's the consequence? Well, it depends on who you are. If you're a business owner who takes out a loan, let's just take, I'm going to use Microsoft. There are 70,000 employees, and every 2 weeks they have to pay them. Well, they're not going to keep as much cash in the checking account, but rather what they do is they take a loan and they basically roll the loan every night. And in that case, that company that takes out that very short-term loan now has to pay less, which is good for the business. So a lot of businesses that take short-term loans are very excited about this drop. On the other hand, if you're a saver and you might have looked at CDs or money markets, well, those instruments offered by banks or other investment companies, those are designed to buy these very short-term instruments, the 30 days or so. And in the past, nobody paid attention to them because those rates are so low. Now, because by design, they buy the high ones, a lot of folks have been attracted to CDs and said, well, let's get CDs. It seems like it's a risk-free way to make a lot of money. Well, it turns out that when the Fed is cutting rates, it is quite likely, and we've seen this, that the rates on CDs and money markets are also coming down. So if you're a saver who was intrigued by the idea, let's just get a CD, no risk, and make 5.5%, well, those days are kind of going away. In fact, we've already seen the rates on CDs drop. And as the Fed continues to cut rates, it's possible that they might continue to drop. So that's with the Fed. What about other rates? Because a lot of us have mortgages, and we think about, listen, how much are these Fed cuts impacting mortgages? Should I wait to get a mortgage until there are further rate cuts? Well, it turns out, folks, that the rates on mortgages, they're not dependent on the very short 30 days, but rather they're dependent on the 10-year Treasury interest rates. And that is the dynamic in the mortgage rate, is that it's dependent on the 10-year rather than the as I said, the short-term rates. And if you want to visualize it, it's quite interesting because you can see that the 10-year Treasury is very closely linked to the the mortgage rate. So as the interest rate on these 10-year Treasuries go up or down, so will the interest rates on mortgages. And what we've seen is something quite interesting, because if you look at for example, you look at the 10-year Treasury in October of 2023, it was about 5%. That was about a year ago, and it was at 5%. Now, in August, let's say, of this year, this is before the Fed start cutting rates, that rate by itself on the 10-year Treasury dropped to about 3.6%, completely independent of what the Fed was doing. It already dropped significantly, even though the Fed had cut no rates. And then the Fed cut rates twice. And in November, right now, of 2024, the 10-year Treasury is actually at about 4.4%. So it's gone up while the Fed has been cutting rates. So it is really important to know that these rates really are driven by the mortgage rates are driven by the 10 years, and these 10-year rates don't really have much to do with the short-term cuts that the Fed is making. And over the past few weeks, I think since the election, what we've seen is that there are higher expectation of inflation over the next few years, which has moved the 10-year interest rates higher. And that's kind of what we see. They went from about 3.6 to about 4.4. And because of that, what we've seen is the mortgage rates go up from about 6% a few weeks ago to about 6.8%. And again, that is all tied into what the market expects from an inflation perspective, which obviously is the baseline. I want to at least make sure that I get my inflation, and that's kind of what investors are expecting. So that's a bit of an overview of interest rates. I really don't want to go super deep, but I wanted to give all of you a sense that interest rates are going up or down. It's a blessing or a curse, depends on who you are. And it's not always good news or bad news. Now, I do want to point out one more thing, is that the inflation has been expected to go up in part because of the election. And I don't want to get political, but I do want to spend some time on this idea of politics in elections, because it is very, very fresh in everybody's mind. And I have to say, I have noticed how anxious people are. And they have been for a while around this election. And in a way, it's legitimate because it is touching on our deeply held beliefs, our core identity as individuals. So I think it's legitimate to say that this has had an impact on all of us because it does touch on our deeply held beliefs, our core identity as individuals. And because of that, it triggers these very strong emotions. I also believe that these emotions are perfectly fine to have because that's what makes us human. So there's nothing wrong with these emotions. What I also found is that really successful investors can acknowledge these emotions because they're real. It's what makes us human. And at the same time, take a step back and disentangle them from investment decisions and be a lot more pragmatic about those investment decisions and make them based on data and evidence rather than how we feel, because those are two different things. So I can tell you that a lot of folks are anxious today, others are ecstatic, and should he make decisions based on those feelings? And my suggestion is let's take a step back and see exactly what is going on, what's the economics of the market, and what does the data suggest. So to begin with, let's just take one step back, as I said, and think of the market not as this gambling casino where you make money, you lose money. That's not what the stock market is. I think the stock market, in its defense, I'm a big defender of the stock market, is a fundamental premise of our society. Because what the stock market allows all of us to do is go buy ownership in companies that we did not start. I have nothing to do with Microsoft. Talking about Microsoft, I don't know Bill Gates. And yet, if I go to the market, I can buy a share of Microsoft, which allows me to have a piece of the profits and the earnings that that company makes. Pretty much like Bill Gates. Not as much as Bill Gates, but certainly conceptually, I can partake in the success of that company. And that gives us all a stake in capitalism, which is fantastic. And we can participate in the ownership right now of about 12,000 companies around the world. So when an election happens, the stock market basically is trying to assess what is the value of owning a piece of a business. That's what the price per share means. If I buy this business, how much should I pay for it today? And every single second, the market's trying to assess the impact of various events onto profits and earnings that companies are expected to make for years and years to go. That's what the market's doing. It's assessing the value of a business today based on what is going on in the world and forming an expectation on the impact. And if it's a positive impact, it's going to go up in value. And if it's a negative impact, it's going to go down in value. And in that respect, when the election happened, not just the actual election day, but even before the election day, the company, the stock market had an assessment of who do they expect to win. And based on the policies that were being discussed during that particular campaign, what the impact might be on different companies. So a lot of what is likely to come has already been priced in, meaning that the market has already adjusted the price based on the expectation of a policy that might help or perhaps hurt a particular company or sector. So you got to be careful not to get on the bandwagon too late. And that's what typically happens is the investors get on the bandwagon too late. And by the time they get there, the price is already adjusted. The second thing so the first thing is that the markets are forward looking. They adjust the price well in advance of a policy being implemented in expectation of that policy. The second thing to note is that whatever the policy is, companies are not going to, just lie down and just take it. They're going to try to figure out a way to make it work. That's the resilience of any business. You try to figure out, how do I make it work? And if an obstacle or barrier is putting in front of me, well, I'm going to try to see how do I go around it. And that's the second important thing. And the third one is that each company's success is based not only on the government policies, but a lot of other variables that are under their own control, which is the products, the customer service, the strategy, how they execute, what competitors do. And because of that, you can find some very random results. So let's look at these three ideas that I put forth. The first one is that the market's price things in. The second one is that the companies are looking to adjust whatever the policy might be. And number three is that the results might vary even within the same industry. So I'm going to start with the first concept because I think that it's quite interesting to look at the policies that were being talked about during the campaign. And the upcoming administration has really talked a lot about tariffs. Tariffs. We're going to tariff everything, and we're going to, charge tariffs. And tariffs are certainly a tool that the government can use. And as an economist, you kind of look and say, well, who's paying the tariff? And it is the importing company. There's just legal logistics. And quite often, when you look at the data, what you see is that the prices tend to go up. Because the consumers are the ones that typically pay more. The companies tend to pass those extra costs to the consumers. So one of the reasons that we saw this increase in inflation expectation is perhaps because of tariffs. Now, if you're a company and you look at how will they impact you, it's good to go back and see how unpredictable the consequences of tariffs can be. And to do that, I'm going to tell you maybe a story that I like just because it just sounds fun. It's called the chicken tax. And I'm not sure how many of you are familiar with the chicken tax, but the chicken tax is a good story. Back in the 1960s, the U.S. farmers were exceedingly good at producing chicken. And they start shipping a lot of chicken at a very low price around the world, including to Europe. And the good old European farmers are like, whoa, wait a second, what's with all this American chicken? And the German farmers in particular, they're really incensed. They said, well, this American chicken is killing us. So they went to their legislators and said, do something about it. And the German legislator basically said, okay, we'll put a tariff on the American chicken so we can protect the German farmers. And that's what they did. They put a chicken tax on the American poultry. Now, the Americans got all incensed. Like, wait a second, we just gave you all the money for the Marshall Plan, and now you're going to tax our chicken? That's not right. You can't do that. And they said, okay, well, I know you're selling a lot of VW bugs and buses back in the 60s. And the U.S. government got a hold of the fact that the Germans were about to release, VW in particular, was about to release a pickup truck. And what they said, okay, you taxed our chicken. Well, what we're going to do is we're going to put a 25% chicken tax on pickup trucks that are made abroad. And at the time, there are no pickup trucks made abroad except this upcoming VW pickup truck. How many of us have heard of VW pickup trucks? Not really. Nobody's ever heard of those because they never came along. It just basically killed the whole thing. But in the process, a few things are important to know. The first one is that it gave the U.S. automakers a huge leg up in that particular segment. And that's when you think of a pickup truck, it's the F-150, it's the Dodge Ram, the Silverado, because the U.S. automakers have been really protected in that space by the chicken tax, which, by the way, is with us today. It's still in place today. 7 years later, 6 years later. So that's the first thing. The second one is that consumers now have fewer choices, probably not as much innovation in pickup trucks. But the third one is it offers a lesson of how did companies negotiate with that? If you're one of these companies that couldn't import without paying the duty, what do? It seems like pretty straightforward. Well, not really, because there are examples of how companies try to get around the chicken tax. And one of them comes from a Subaru. Back in the 60s, they had a vehicle called the Brat, the Subaru Brat. And what they did to kind of get around that, they bolted 2 seats in the bed of the truck. And they said, well, it's not like a pickup truck. Look, he's got 2 seats in the back. And obviously, as a consumer, you can just unbolt those and you get your pickup truck. So that was one way the companies did it. The other one is Ford, for example, when he was bringing in pickup trucks from abroad, what it did, it basically just said, okay, don't put the bed. Just make it out there and just don't put the bed, and we'll attach the bed when it gets here. So is this a pickup truck? No, it doesn't have a bed. So don't categorize the pickup truck. It's just it's got a cabin. And so the companies try to get creative and figure out. And I think that's an important lesson that companies will look to negotiate with whatever is put ahead of them. So that's kind of the first lesson, that companies do get creative. They're resilient. They'll figure out a way to do it. And the outcome over the long run is unpredictable. And in some ways, it could actually benefit U.S. companies, but it will hurt consumers. Now, what about this other idea that getting the government with some of these is going to benefit a company? And to look at that, the previous administration in 2017, when they came in, they said, we want to make more things in the U.S. So they talked about domestic manufacturing and how to support it, how to bring it to life. And one of the industries that they picked on was steel. And it turns out there's a company that carries the name of the industry. It's called United States Steel Corporation. And if you look at the price per share for United States Steel, it had, was dropping quite a bit. It lost, more than half the value in a fairly short time. And then the administration started talking about tariffs. Well, let's just put tariffs in place. And when they start talking about that, perhaps in expectation of those tariffs, again, there are no tariffs, but in expectation, which is what we talked about it, what you saw is that the stock price just starts significantly going up and going up and up and up and up, almost double again in value. And in that respect, you got to go, wait a second. So that's a good thing. So if the government gets behind us, well, that might be a good reason to get behind U.S. Steel, because there are policies that support the steel industry right now. But there was no clarity. There was nothing. There was just an expectation that maybe tariffs will come. Did they ever come? Yes. March of 2018, you got steel tariffs against foreign producers that gave U.S. Steel a very big leg up. And that's when investors, I heard a lot of folks saying, this is where we want to invest now, because the government has the back of U.S. Steel. So what if you fell into that seductive narrative and you bought U.S. Steel? Well, by the end of the previous administration, U.S. Steel had lost most of its value, despite the fact that it had the full the full backing of the U.S. government through very tangible and serious tariffs. It did not make a difference. It lost the majority of its value, and partly because it's about maybe when the price of steel goes up, which is what happened. Car manufacturers and washing machine makers, they didn't buy as much steel. You're going to have foreign countries reciprocate and make it harder for U.S. Steel to compete. Perhaps their customer service or their products. There's so many variables, but ultimately, just because the U.S. government has your back does not mean that much. And even if you look at the steel industry, look at the current administration. There is a good example, because the current administration has been pushing much more green energy. And sustainable energy, which a lot of folks believe. And frankly, 3 years ago, I wanted to put some solar panels on my roof here in LA. And I got a bid from a company called First Solar. And recently I looked to see what would have happened if you had invested in First Solar, over the past 3.5 years, and you would have more than doubled your money. So really nice outcome if you invested in First Solar and solar panels companies like First Solar. Now, because I remember being a somehow halfway smart consumer, I also want to get another bid just to make sure I'm not being overcharged. And if you go to Costco right now, in fact, there's a booth that is not by First Solar, but by Sunrun. So if you look at Sunrun, it's an alternative company that does the same thing. Sunrun, over the past 3.5 years, despite being exactly in the same position as First Solar, it lost about 75% of its value. And when they started, their price per share was pretty much neck and neck. And then it just completely diverged 3.5 years later. And why is that? It might have to do with the customer service, the strategy, so many other variables. But just because the government has your back doesn't mean that that's going to translate in investment success across the board, which is kind of the third idea that I put forth. And by the way, I was in Oklahoma not long ago, and somebody said, yeah, but at least they had some friends in DC Fossil fuel has been terrible. Nobody likes fossil fuel, blah, blah. And just out of curiosity, I looked at ExxonMobil over the exact same time period. You would have more than tripled your money, in that time frame in an industry that doesn't appear to have as many friends in DC. So don't get caught up in that seductive narrative that, hey, somehow this is going to translate in success or not success. It's just not the case. There are too many other variables that might make a difference. So what if you go now from sectors to broader policy? Because presidents come in and they do have a lot of initiatives. They'll have a lot of ideas. And to what degree do those impact the market? And what are the policies that really help the market versus hurt it? And we have data in the stock market going back to the 1920s in the US. And rather than go in the 20s, what I thought I would do is go in my lifetime. I'm born in 1969. I'm 55, and I wanted to know, okay, the market on average has grown by about 10% per year. So I'm going to use that as a yardstick. 10% per year is the growth in the U.S. market. Now, what if you look at the average per year annualized for different presidents? How does that compare to 10%? What can we learn from looking at the different presidents and their performance while they were in the White House relative to the market? So when I was born, President Nixon was in the White House, and for about 5.5 years, the market, in fact, did not grow, but dropped by about 2.9% per year on average. And then he leaves the White House, and his vice president comes along, Jerry Ford, and the market skyrockets at over 20% per year. And by the way, Gerald Ford was never elected vice president. He was never elected president. He was a president. They just incidental. They just happened to be around there, and eventually got in the White House. And in 1977, he loses to Jimmy Carter, who comes in for one term. The market on average goes up by 11.7%, a bit above average. And then in the 1980s, President Reagan comes along, 2 terms. The market goes up 15.8 for 8 years on average. And then his vice president comes in, 1 term, 4 years, market goes up 13.9%. Followed by President Clinton in the 90s. The market goes up quite nicely, 17.6 for 8 years in the 90s. And then we had that contested election, Bush versus Gore. And if you remember, President Bush comes along, and if you look at the 8 years of the George W. Bush administration, interestingly, the market on average drops by 4.4% per year for 8 years. And then we had President Obama and then President Trump. And the reason I put this up is that I want to start with just the basic question. Is it obvious that having a Republican or a Democrat in the White House is better or worse for the markets? And the reality, folks, you can't say that. I mean, I've asked this question to audiences around the country and the world, and nobody can say there's an obvious pattern. Now, what about policies? It was the case that there was a president who cut taxes to specifically the stock market investing, capital gains dividends. And if you heard about that, it would be like, well, that's really good news for the market. I do expect the market's going to jump because we have these tax cuts. And we did have exactly that set of policies, and they came from none other than George W. Bush. And yet somehow, despite these incredibly tax-friendly policies, the market dropped by 4.4%. Was he a terrible president for the markets? I don't think it's fair. And I don't think it's fair at all to say that he was not good for the markets. Why? He came in just as the dot-com was going bust. How much did he have to do with the dot-com bust? Nothing at all. 9/11 happened 9 months into his term, and he walked off at the very bottom of the financial crisis. Should we say that he wasn't good for the markets? I don't think that's fair. The same way that if you look at President Clinton, well, he happened to be there in the early 90s just as Microsoft and Pets.com and Amazon, they're all taken off. And again, I'm not sure how much the White House had to do with Microsoft Windows or Office or any other things that happen in Silicon Valley. So it is, you got to be careful assigning credit or blame. But what about policies? Because I hear so much about President Reagan. He was very good for business. And he really made a big difference because he was focused on tax cuts and initiatives to stimulate growth. And the market responded really well, 15.8% per year on average. And I do remember that when President Obama was running, there was anxiety in some parts of the country, because what if we elect somebody whose priorities might be around social programs rather than business and tax cuts? Well, it's going to be a bloodbath in the market, and we need to, sell everything and move to Canada, because that's not a socialist country. So they're afraid, and people are afraid, and they say it's going to be terrible in the market. So how badly did the market do during a president really known for healthcare rather than business initiatives and tax cuts? On average, it went up by 16%. What's the difference there? It's not really any difference. Whether you have a president focused on taxes and business versus one focused on social programs and healthcare. So it is interesting that quite often people want to believe a certain thing. And I think it's their emotions being projected onto what they think is going to happen in the market. But when you look at the data, there's nothing to suggest that this is going to be the case. Now, it's not all about presidents. And as we know right now, we have a unified government. The Republicans are in control. And interestingly enough, 2 years ago, this is exactly 2 years ago, it was exactly the opposite situation. The Democrats were in control. And 3 years ago, I had this thought that perhaps, if you have a split government, it's hard to say how the policies of any one party drives the market. On the other hand, there are times perhaps when one party is in full control. In other words, they control the White House, they control the Senate and the House at the same time. So if we look at times when one party is in full control, well, that might give us a sense of which party, which set of policies might be better or worse for the market, because again, it's more than just the president. So when I went back to the 20s, this is like 3 years ago, when I went back to the 20s, what I found interesting enough is that the Republicans had the single party unified government control for 13 years. And a simple average of these 13 years showed that the market did well. It went up by 14.52%. And that's during the Republican unified single party control. What about Democrats? Well, it turns out they also had this single party control, but not for 13 years. It was actually a lot longer, 34 years, where they had this unified party control. And the question is, well, how did the market do during the 34 years of the Democratic unified government control? And folks, I remember 3 years ago, somebody stood up and said, listen, I don't want to see this number because you're going to try to sell me on one party being better than the other. I don't want to know. And I was like, no, I'm just going to show the number. I know you're very emotional, but you make your own conclusions. You draw your own conclusions from this. When we average the 34 years when the Democrats were in control, it turns out that on average, the market went up by 14.52%. It is identical to the second decimal, So when people are saying that, look, one party is better than the other in the market, when one president, one set of policies, all of this, there's nothing in the data that suggests that you ought to make a move with your money solely because of politics. And it makes sense. Again, it's a company who's looking to make money. You look at Apple or Facebook or you name it, or Nvidia, what's going to matter more? Who's in the White House, or their products, the services, strategy, how they execute? Politics is one of the many variables that impact the success and the profits of the company. It just turns out it's not a primary one. It's not one that you can point and say, here's the election outcome, and that's what's going to happen to any one company or the market. And maybe, Jonathan, I'll wrap up with just a little thought that I had because I was baking cookies with my daughter. And when you bake the cookies, you put in the eggs, the sugar, the flour, the butter, you mix everything in, you pop it in the oven. And when the cookie's done and you break it apart, you can't really point and say, aha, I recognize the egg yolk in there. No, you can't. It's mixed in with so many other ingredients that it becomes indistinguishable. And that's what I think politics is ultimately. It's the egg yolk in a cookie. It's somewhere in there baked. It's just not something that you can see, and certainly not something that you want to build an investment strategy around it. So don't make an egg yolk cookie. That's not going to be very good. But rather acknowledge it's somewhere there. The markets have already priced it in, and the companies will be resilient enough to navigate whatever times. And folks, let's not forget, 2 years from now, there will be another election. 4 years from now, we're going to go through exactly the same process as we did today. And a lot of the companies, when they have these long-term horizon, they're not making decisions based on what's going to happen over the next 2 years. Their projects might take 4 or 5 years even to get started. So a lot of the decisions are, they're not based on politics. And because of that, I really want to kind of emphasize again how strong these emotions are, how legitimate they are. And at the same time, you are buying ownership in companies around the world. You have 3,000 companies in the US, about 9,000 others around the world. They're all going to try to find a way to make money, irrespective of who's in the White House. And us as consumers are going to continue to be resilient. I had the same exact bowl of yogurt with berries the day before and the day after. I mean, we're all consuming the same thing. We're taking our trips. We're doing the same thing, and that's what the resilience of consumers that leads to resilience of companies, and ultimately the resilience of the market.
Okay. Hi, everybody. Good morning. First of all, Apollo, thank you for a masterful presentation. I think you're too humble to let people know that you are one of the giants on whose shoulders we sit. Dimensional is pretty much informed by the wisdom of Nobel Prize winning economics. That's not stock picking or market timing, as you see. And we say at RVW, we say we don't predict, we prepare. And that's really the approach we use. We think of our portfolio of equities as being a kind of a Darwinian best of breed selection process, picked based on the attributes or factors that are present in the companies. As Jonathan has said, we neither look to the future because nobody predicts accurately, nor do we look to the past because it's usually irrelevant in terms of where we are. We are present focused, and our portfolios are internally dynamic in the present. I just wanted to wrap up. First of all, thank you very much, Apollo, and thank you, John, for the introduction. Just a quickie. It's approaching year-end tax time, and I wanted to deal with some evergreen tax principles that I think are worth thinking about. This is the time of the year where if you haven't already done that, you should do a tax projection. In other words, meet with your tax preparer and have them do a quick and dirty of what your taxes are going to look like for 2024. The reason for that is because determining where you are in 24 and possibly where you're likely to be in 25 will determine many of the critical decisions you'll make. For example, do you want to do a Roth conversion to an IRA to a Roth from a regular pension plan? That's very attractive if you happen to have a lean year for income purposes. On the other hand, if you have a high income year for tax purposes, you want to defer some of your deductions. You want to accelerate some of your deductions from next year into this year. If you have a very high taxable income this year, you may want to bunch up your charitable deductions, for example, or your deductible business expenses if you're a cash basis taxpayer. What I'm saying is that the core to tax planning at this time of the year is to do a projection. We have a saying which says surprises are for birthdays, not for tax time. And the last thing you want in April is to find out either that you missed an opportunity, because after December 31st, opportunities pretty much evaporate as to what you can do to reduce your taxes or defer your taxes. You don't want to find you missed an opportunity or you're saddled with an unexpected tax bill. So I would just say to you, at the heart of everything you're doing right now, tax projection is part of it. Instead of fixating on who won the election, and as we heard so well from Apollo, what it's likely to impact the market, we are perma-bulls. We are permanently bullish about the market. And 200 years of history shows you that the market is one long, upward sloping bull market interrupted by periods of decline. I will just give you one statistic that I think will make the point quite eloquently. I came to this country in 1977. The Dow Jones, which, as you know, is not the best place to invest or the best index to rely on, but the Dow Jones, when we came, it was around 850. It's now over 44,000. And all you had to do over that period was nothing. Anything you did that interrupted that tax advantage compounding disturbed the portfolio. And the chance of getting it right, when you time the market, you got to get out at the right time, you got to get back in at the right time. Almost nobody gets those right. Staying in and enduring the price you pay for extraordinary returns, which is simply the enduring of volatility. It's a bumpy ride upwards. That's what it is. And so I wish you a wonderful holiday season, a successful 2025. Let's wish Trump and the Republicans who have taken control much success. We all pray for a successful term. regardless of what you would have liked to happen. We're all now in the same country, with the same president, the same administration. We should all pray for and hope for a successful term for everybody and a great year for all of us. Happy holidays to all. And thank you, Apollo. Thank you, John. And if there are any questions or issues, please email any of us. We'd be happy to respond. Thank you.